On behalf of Quorum Business Advisors, welcome to this lesson. Reasons for Seller Financing. This lesson is part of an educational series from us to you, covering the reasons for seller financing. Before we get started, we at Quorum Business Advisors would like to express our thanks for considering us to help guide you on this all-important and exciting journey. Quorum Business Advisors comprises highly skilled, professional, board-certified, and accredited intermediaries. Owner Anthony Rigney is the former president, North Florida chapter of Business Brokers of Florida. The business offers professional business brokerage services including buyer searches, business sales, valuations, and exit planning. Ready to get started? Let's dive in. Seller financing is a pivotal step you'll encounter when selling your business. Economic conditions are not always ideal, and oftentimes, lenders will require you, the seller, to carry a note. When discussing the sale of your business, our qualified business intermediaries will discuss the amount that you are willing to seller finance as it relates to the transaction. This step will be done when the business intermediary is drafting the listing agreement. In the current credit market, it is becoming more frequent for sellers to hold a note, and with it, a portion of the risk of the transaction. While this may not sound ideal to you, it does place you in a better position to sell at a higher price. But let's take a look at what seller financing is. When the seller holds a seller's note for a portion of the sale, this is known as seller financing. You may be wondering what a seller's note is then. Let's explain. A seller's note is an official agreement in written form between the seller and the buyer. In this agreement, it cites everything that's been contractually agreed to. These include the loan amount, the interest rate, and the number of installments until the loan is fully settled. If the seller agrees to hold a seller's note, this will be cited in the purchase agreement. But this seller's note and purchase agreement is secured by a personal guarantee from the buyer in both a corporate and personal capacity. Remember, these intricate legal documents should be drafted by a professional attorney who specializes in contracts and agreements of this nature. The personal guarantee gives the seller a financial and legal instrument to lien any or all of the buyer's assets should the buyer default on payments. The lien granted to the seller is formally registered together with a list of assets in the local county and state registries as security for the loan. Seller financing enables you to achieve full sale price for your business, as well as to market your business to a broader base of qualified, prospective buyers. Aside from these benefits, there are a few more benefits for you, the seller, when it comes to seller financing. Tax benefits. Have you considered the tax implications if you withdraw all the cash at the date of closing the sale? You'd be liable for capital gains tax and a hefty tax bill. With seller financing, this tax burden is eased for you. If you're still unsure about the tax implications, it is strongly recommended you speak to your CPA or tax attorney, who should be able to illustrate the benefits of seller financing. Market to a wider buyer audience. One of the distinct marketing benefits of seller financing is that, as a result of you holding up a seller's note, the buyer will be required to place a decreased down payment when purchasing your business. Why this makes good business sense is that your business is automatically marketed to a broader range of qualified buyers. Something to consider when deciding on whether to engage in seller financing is the current economic climate. At times, buyers or the business may not qualify for bank financing, and seller financing may be the only route, even if there are plenty of assets for a bank to collateralize. Banks and lenders have become more reluctant to lend, and for certain industries, their criteria have become more rigid, even with assets being put up as security against business loans. While SBA loan guarantees are available, it cannot guarantee that a bank or lender will grant a loan for a transaction. Banks may require a seller to hold a small note in the 5% to 10% range to assist the buyer with down payment. or to ensure the seller has skin in the game to assure a successful transition to the buyer. If you're really eager to sell and start your next chapter, you may need to strongly consider seller financing. Here are some additional considerations to protect your seller financing investment. Consideration 1. Even though your business has been exposed to a wider net of buyers, you may want to negotiate a larger down payment. The more the buyer is invested financially, the more likely he or she is to commit to this new venture. If the buyer successfully operates the business, the more likely you are to receive your payments. Consideration 2. Secondly, when the seller note is the sole financing of the deal, you have the full authority and ability to lien the assets of the business. You then also have the option of stepping back into the business as an owner or appointing a manager to run the business on your behalf. Consideration 3. You must verify the buyer's credit and financial history, as well as whether he or she has sufficient working capital and liquidity to acquire and operate your business. If you take all these considerations into account, you should, by now, have some peace of mind about seller financing. Remember, each transaction is different, so speak to one of our business intermediaries for a custom strategy to effectively market and sell your business. We hope you enjoyed this lesson. On behalf of Quorum Business Advisors, we'd like to thank you for listening. Tune in next time. If you have any questions about seller financing, please do not hesitate to get in touch.